Anna Parker from Morgan Stanley came out and said by 2020, in 6 years, you're going to see 3,000 on the S&P. Okay, so I just want to read what he said was equities should benefit from a scenario where the probability of a cycle peak remains low for some time. So 3,000 by 2020. What do you think?
Well, kudos to him for having the boldness to put a 5-year.
But I ain't doing it.
Because God knows, I certainly don't have that degree of boldness. You know, equities generally go higher. I think you can just trend line the progress in equities so far, trend line continued economic improvement, and you get to 3,000 pretty easily. Whether or not we have any sort of disruptions in the near term is pretty tough. I mean, that's why we tend to have something more closer to a 6 to 12 month outlook when we're looking at stocks, is kind of foreseeing the future into 5 years. I think there was a little bit
built into that. I mean, he said basically if you see that it would be sort of the peak cycle scenario here, 3,000 would be the peak. And that it's contingent upon getting 6% profit growth per year, which again is not really
average.
I mean, it's not a very high bar.
No, and that's average. It's 6% per year is the long-term average profit growth. I mean, at 3,000, I would assume he's saying no adjustment to PE. We're just sticking at the current level of PE.
Yeah, he's saying that the current the equity index trade at 17 times.
Yeah,
Gina's not impressed. I can tell.
Well, I don't want to judge anybody else's analysis. I can only speak to my own, but I'm not saying it's unreasonable. I mean, it certainly is a reasonable forecast if you're willing to put your neck out there for 5 years down the line. Sure, why not? 6% earnings growth is a long-term average. Who's to say where PE is going to go, so why not hold it relatively steady?
Right.
Right? I mean, I think that we're in the business of trying to navigate the market over shorter terms, and what we tend to do, at least in my job, is focus more on sector strategy and how to outperform the benchmark in a short-term period of time. Yeah, you want to hold stocks for the long run, right? And I think that may be his point. Right, in a long-term outlook,
you're going to bet anywhere.
Equities look pretty good structurally relative to other asset classes. They are a little bit overvalued maybe here in the short run, but when you're thinking about economic growth ultimately improving, and hopefully we get a little inflation bias, equities should perform relatively well.
So let's talk about over the shorter term PE, because I know in a recent note you talked about PE versus the yield curve. So the S&P 500 PE, we have a chart of it that we actually looked at last week, I think, when your note came out, and shows basically them converging, and that the yield curve versus predictions has actually been narrowing, and that we might actually see valuations come down a little bit. Can you walk us through that?
That's actually what normally happens in the second half of an economic cycle. So if we are at a point where the Fed is going to start to increase short-term interest rates, what's happened in each of the last two economic cycles at that point is the yield curve has flattened. Well, coincidentally enough, so far this year the yield curve has flattened. It's contrary to consensus expectations, but quite normal in a historical sense. So if the yield curve flattens, what happens is what we were looking at. And for the market broadly, it doesn't mean a whole lot, but for PE specifically, it usually means contraction. In 7 of the last 8 instances in which the yield curve has flattened over the last 40 years, you've seen the PE on the index fall. What that means for the market at large is we become more dependent upon earnings growth to drive stock prices. So you should see earnings growth accelerate to offset that PE compression. You should see sectors start to migrate returns relative to the pace of earnings growth, and earnings become more important. And if you look at what the market's done over the last 18 months, it's been all about PE expansion. Right? Earnings have only grown at this very slow, historically slow pace, and PE has expanded tremendously to drive stock prices higher. We should see those roles reverse.
And I know that you tend to look at, say, cyclicals to take advantage of that, but you also still like healthcare, which seems a little bit counterintuitive. And you see the S&P healthcare sector seems so overextended from that spread between the 2 and the 10-year. Well, I should say actually from the 5 and the 30-year, you can see how much more it's extended as you see that yield curve actually go down.
This is where we're sticking our neck out, because historically you do want to migrate toward more cyclical sectors, and healthcare has traditionally traded as something more of a defensive sector. In this particular cycle, we're saying, look, healthcare might be an outlier relative to the past. If the yield curve keeps flattening and the Fed starts to increase interest rates as we're expecting, you would normally want to be in mid to later stage cyclicals. But we're adding healthcare in there simply because healthcare is going through an anomalous experience. In history, it's shown one of the slower growth rates on the index. Thereby, it's been a more defensive sort of sector. It tends to perform well as other sectors are growing faster. In this particular environment, healthcare is the fastest growing sector in terms of earnings growth on the index. And we think that's going to continue over the next 12 months or so, and that drives relative performance of the healthcare sector in our view.